It's a rare thing in the world of investing that you just find the perfect stock, right? Imagine it's in the best industry, right? It's gone up 200% over the last year. Its PE is still 20, right? Stocks like that don't usually exist, right? Because people want to buy it up at that price. If you just, for whatever reason, magically can make NVIDIA 20 PE, right? Snap your fingers. It's going to run right back up to 50 or 60 because everyone would buy NVIDIA at those levels. That's just how stocks work. So with Cisco specifically, there is a lot to like about it, right? We can see, I love the industry they're in, right? They do data center stuff. And it's just super important. I basically work at a data center. It's more complicated than that. But we use Cisco stuff because there's nothing that is really on the market that can compete with it, right? So, I covered it on this channel before, and I talk about it almost every time, the economic moat. Wide economic moat. No one can really do what they do as well as they do it, right? However, they haven't been a stock that has done particularly well, and they're a business that has made some poor decisions over the years that has led to not as good growth. Now, you have to factor in they do pay a higher dividend. It's about twice the S&P 500 levels. So the share price, just looking at that, is not entirely the full picture. However, over the last decade, even with that, it's going to freeze up. So unfortunately, we aren't going to use that because I don't want to re-record this video. But just believe me when you say it's about, over the last decade, almost up exactly 100%, which is fine. That's not terrible, but that's not what you aim for, as the S&P 500 is up 240%-ish. It's a little less than, I think it's 220 over the last decade. So this is a stock that has, even when you factor in the dividends, it has underperformed. It just has. However, you do have to factor in, okay, this stock is currently cheaper, right? Forward PE at 16.5. That is pretty cheap. S&P 500 forward PE is about 23. So this is a stock, if we're going off forward PE, that is cheaper. It is cheaper than the S&P 500, which is a good thing because it's underperformed it. Let's look a little bit at the history of the dividend. Yeah, I mean, they're hiking it a bit, but not as much as they were in 2016. They're hiking at about inflation rate. So that doesn't seem to be the primary way they're trying to derive value back to shareholders. If you wanted to fit this in a dividend portfolio as one that was like supposed to outpace inflation and then be one of your less yielders, okay, you can maybe do that, right? I personally wouldn't. I don't think the yield's high enough in that sense. But I would try to count. If I own the stock, I do not. I think there's worse things to be made. I've debated it at times, right? But the bet you are making is, okay, can they start turning things around? They don't even have to grow a crazy amount. If they can derive, even a decent, if they can start growing at a normal company rate, right? 10% every year, S&P 500 goes up 10%, right? Obviously, it's a little bit more complicated than that. There's some that outperform dramatically, some that underperform. But let's just say S&P 500 goes up 10% every year, Cisco goes up 10% every year, right? If they could start doing that, you would actually go up more than that because this would be valued at a stock that is average. And right now, it is valued at a stock that is cheaper than average, right? So the bet you are making is if this can even become an average growing stock at about 10%, there is a lot of value to be had there, and it's gonna pay off. But Cisco historically over the last decade, even a little bit plus, this chart will load. We got it to load, beautiful, right? I mean, even in so obviously .com bubble, you're basically flat, right? And then 2007, which was a long time ago, but still, you wouldn't be up even 100% from then. So this, historically, right, I'm not trying to dog on it too much, but historically this is a company that has not performed that great. They just haven't. It's just reality. So you're making that bet. Okay, the world is going for more of what Cisco does. It's super important. They can turn things around and be more efficient. Then you're going to make a decent amount of money, I think, just because even if it goes up to, like I said, inflated to average PE levels, right? If forward PE goes to 23 because it's growing more, you're going to get, I can't do that off the top of my head, what's that, 40% on top of the 10% yearly growth-ish, right? So this is, and that's factored in with the dividends as well, so it'd be 8%, and then 2.5%, whatever, doesn't really matter. The point being that is the quote-unquote bet you are making. I don't like to say it like it's a gamble, but in some sense, single stock sort of is. And I don't get me wrong, I like single stocks. But anyways, Schwab, they think it's going to do well. They do. They think it's going to be the top 26% of all stocks performing over the next year, right? That is a pretty good rating. We already talked about the economic moat is why that is true. Like I said, there's many worse ones because they're fairly cheap and they're in a very important industry and no one can really do what they do, right? You got a 3 stars, buy, long, buy, moderate ESG score. Let's take a look at the historical P over the last year and a half. We were a little bit at the higher end of those levels, right? Forward P is 12, now it's at 16, 16 to 25. I think they've had some decent earnings, right? Yeah, they've been beating expectations, not dramatically, but they've been beating. So, and they're projected fairly well as well. So their P is rising a little bit because they're actually succeeding decently well, right? And we're getting a decent amount of people to say buy on it as well. It looks like that's 13, I think it's 12 actually. 12 of the 28 are saying buy. The rest are saying hold. One dude's saying, I believe that's sell. I can't quite tell between the orange and the red, but it looks like sell. But that's pretty standard for a stock with these PE valuations and this growth. And I guess one more thing to factor into it, if you're planning on holding this, even if it were to run sideways for a bit, right? And many stocks do for whatever reason, you're still getting a decent dividend on it. I don't think this stock is going to go down by any means, like over the long period. I think what they do, they're too important, which almost is a negative because the business doesn't really have a whole lot to compete against, right? So they can just kind of do fine, just kind of floating around. But anyways, the dividend is good enough where if it were to run sideways for 2 years, and you're like, well, nothing out of that, I'll sell and I'll move money around, you still got a 2.5% dividend, which is something, right? And I think that's one of the lower end cases for this as well. So I think I've said what I wanted to say on this. I'm not going to reiterate anymore. If you enjoyed this video, I'd appreciate if you liked or subscribed. I do daily stock content on this channel covering everything from tech to ETFs to dividends. If you did hit subscribe, I appreciate it a lot because YouTube recommends my content out more when people subscribe to me. YouTube's like, hey, people enjoy this guy, and they recommend my content out more. But if you enjoyed this video, well, I already said all that stuff. I appreciate all of you for watching who did, and I hope to catch you next time.